Good morning and welcome. You're watching Market Cafe on ET Now. It's the start of another day of trade, of course, and we have a truncated week, which is just 4 days, and we have a very happening week because we have a couple of central banks coming out with their policies, including the Federal Reserve as well as the ECB. It's a very interesting week. Ankita, how have markets kicked off?
Absolutely, Harsh. Good morning to you and good morning, everyone. So now just before the FOMC meet, which is likely to happen today, the markets fell yesterday because the banking contagion fears are back on the Wall Street, it seems. And yesterday also the stocks tumbled, as traders really fear the contagion that happened in the banking sector, and that's really weighing down the markets ahead of the Federal Reserve rate hike, which is today. The Dow Jones Industrial Average fell as much as 367 points yesterday. The S&P 500 fell 1.1%, and the Nasdaq Composite dropped 1% in trade yesterday. All three major averages fell for a second consecutive session. The banking shares slid with the SPDR S&P Regional Banking ETF dropping more than 6%. Now, traders are now questioning the stability of the smaller regional financial institutions after the crisis that engulfed the Wall Street in March. Now, US service PMI data is also expected, and the street is expecting to show a reading at 53.7 for April, which is in line with the prior month. Also, the ADP job data that's likely to come out, the economists are expecting a rise of 1,33,000 jobs, declining from the 1,45,000 jobs increase in the prior month. So there is an expectation that the labor market is cooling off as a result of the rate hikes. And of course, the rate hike decision is as of today, and the street is penciling in a 25 basis points rate hike. Moving on to the European markets tumbled yesterday, as a fall in the oil prices drove the energy stocks lower, and the investors braced for an expected Federal Reserve rate hike. All eyes out on that. The Pan-European Stock 600 index was mixed throughout the morning and declined through the afternoon to close in at 1.2% lower. DAX and FTSE both down 1.2%, and CSE was down 1.4% in trade. So a sea of red coming in there, Harsh, before the FOMC and the ECB rate decision.
Well, Ankita, yes, that's absolutely right. In fact, oil is in focus. It's the one piece which is largely in focus, and again it's seen a sharp slide. We've seen oil fall 5% through yesterday. A couple of factors playing out as usual. One is the fact that there's of course a growing contagion risk in the US with regard to banking, so there is some amount of negativity coming out from there. The other piece also is the fact that there is going to be a rate hike, 25 bips, and some would assume that a lot of that is priced in, but it seems not, given the kind of reaction that oil has really seen. And lastly, what has started to really play out also is the fact that there is some amount of fear also that the US may default on its debt, and that fear is really aggravating that pressure on oil. So a couple of factors, largely global macros, really driving oil lower, but it's 5% lower, quite sharply lower. And in fact, let's take a look at both WTI as well as Brent. So WTI currently is at $71.50 a barrel, and Brent is at $75.3 a barrel, both seeing sharp cuts.
Well below the $80 per barrel mark, Harsh. Sharp decline in the oil prices. And we'll move on then to the important events that we need to keep a track of today. Of course, we have the FOMC rate decision, very important number that the whole street is watching out for. S&P Global Composite data is likely to come out today. We also have the service PMI data that will be coming out of India and the US as of today. Of course, we have the earnings season that's going on, and we have Titan that will be reporting its Q4 earnings, and amongst the other companies that are not a part of the Nifty 50 companies are ABB India, Chola Finance, Havells, Tata Chemicals, Petronet, LNG, Sona BLW, KEC International, Godrej Properties, Adani Wilmar, and MRF that will be reporting their Q4 numbers as of today. Also in the corporate action, we have Godrej Properties that will be considering a fundraise by debt securities. We have Awas Financiers that will be considering raising funds by way of debt again. And we have Symphony, whose buyback issue will open as of today.
Right, absolutely. We'll have to keep an eye out on all of those movers in trade today. But we'll quickly move on. All eyes will be on the US Central Bank. That will be the theme that plays out this week. Whether it takes a hawkish or a dovish stance, and can its moves be boiled down to just a word? Is Powell finally ready to hit the pause on the fastest rate hike cycle in almost 40 years? The street is penciling in a 25 basis point rate hike. We did mention that. And that will take the funds rate to 5.25%, the highest since 2007.
And another important data to track, the number of job openings in the United States had hit the lowest level since May 2021, showing signs that the labor market is in the cool-off mode despite a high interest rate scenario. Job openings have dipped to 9.6 million mark in March versus 10 million in February.
And US short seller Hindenburg's latest target is activist investor Carl Icahn's energy to pharma conglomerate, ICANH Enterprises. The Hindenburg report claims ICANH Enterprises is a Ponzi-like structure. ICANH's fortune sank by an unprecedented 41% to $14.6 billion, and the man went from the 58th richest person to the 119th.
And US Vice President Kamala Harris is all set to meet Microsoft and Google, OpenAI and Anthropic to discuss AI development. The Vice President is expected to address the need for safeguards for potential risks from AI, thereby also emphasizing on the importance of ethical innovation.
Right, and we're in the thick of earnings and a stellar first quarter coming in from car maker Ford with a good beat on both top and bottom lines, largely boosted by their fleet and legacy trucks division. But despite a robust first quarter, the company issued a tempered outlook considering losses stemming from their electric vehicle unit.
And meanwhile, Tesla has gone ahead and hiked prices in as many as 4 regions, including Canada, China, Japan, and the US. This after the company had in fact slashed prices of its top-selling vehicles at the start of the year. The US car maker has raised the entry prices of its Model Y and Model 3 EVs in the US by $250. This, do remember, is the second hike in less than 2 weeks after already hiking prices multiple times in the past.
Well, and switching focus, the dynamic duo of Indian badminton Satwik Reddy and Chirag Shetty scripted history at the Asian Badminton Championships. The duo ended a 58-year-old wait for the country by defeating the Malaysian team in the second and third sets and winning the gold medal. They've become the first Indians to win in men's doubles at the championships. Times Network, Karishma spoke exclusively to the star badminton champ Chirag Shetty. Listen in to this conversation.
Joining us is Chirag Shetty, who has created history at the Asian Championships. Chirag, firstly, thank you so much for joining us and congratulations.
Thank you so much.
You and Satwik have ended a 58-year-long wait for a gold medal. You've done it in style, beating the Malaysian opponents. How does that feel?
It feels really good. I think both me and Satwik have had this thing where we want to medal at the major events, and Asian Championships definitely stands out, is part of it, and to be able to, I think after it was almost 58 years after Dinesh Khanna won a gold medal in the singles event, that an Indian was able to win the Continental Championships. So I think it feels surreal that we were able to do that.
And this is the second gold medal, but the first ever in the men's doubles category. So clearly, you and Satwik are on a roll, because there's the Thomas Cup win, then there are other wins as well. The CWG, then the World Championship bronze. So the pairing is, quite the talk at the moment.
Well, yeah, obviously it feels really good that 2022 definitely was a landmark year for both me and Satwik. But having said that, I think we definitely are meant for bigger and greater things. So I think there are a lot more tournaments that need to be won.
And, if you could just talk us through the winning moments, because I saw the coach also doing a very intense fist pump over there, you lying down on the ground. Can you talk us through, what the first conversation was and just what the trio felt in that moment?
All three of us were in different parts of the court, and nobody really had a clue what went down there, because I think at 13-7 in the second set, when we were down, nobody would have expected us to get back into the game, because we weren't playing at the best of our abilities, but we stuck till the very end, and we never really gave up. And to get back and then going on to win the title, I think we were in pure disbelief, and I, for a fact, just fell down on the court.
All right, then it's time for us to slip into a short break. You don't go anywhere. After the break, we go domestic.
Welcome back. You're watching Market Cafe on ET Now. Now, one particular company which is in the news at the moment is Go First, and lenders are meeting up today after the bankrupt airline filed for voluntary insolvency proceedings. Sources told ET Now that lenders have an exposure of over 6,500 crore toward Go First, and the airline has not informed them before filing for insolvency. Ankur Mishra joins in with more.
Yes, sources say that Go First lenders are set to meet soon after the airline has decided for voluntary application in the insolvency court. Now, sources also say that lenders were not informed. There was no formal communication which was sent by the company about this application which they had an intention to file. Now, as soon as the court admits the petition as an official procedure, lenders will receive notices from the court, and future course of strategy needs to be decided by the lenders on how to go about this case now on recovering of the dues. As far as the total exposure is concerned, we learned through reliable sources that at least an exposure of rupees 6,500 crore is likely to be there from the airline, and lenders like Central Bank of India may have an exposure of over rupees 1,500 crore. Similarly, Bank of Baroda may have an exposure of over rupees 1,400 crore from the airline. Now, as soon as the insolvency proceedings begin in the court, the lenders will have to present their case in the court, and accordingly, the strategy is being chalked out by the lenders. Now, we need to wait and see how soon the court admits the petition so that the actual IBC proceedings begin for Go First.
Moving on now, worried over the low recovery rate from written off accounts, the Finance Ministry has asked state-owned lenders to increase it to over 40%. Now, currently the recovery rate from written off accounts is less than 15%. The Finance Ministry is in its review meeting with PSU banks asked them to expedite loan recovery processes. Now, let me go across to my colleague Sumit to find out what was discussed in the meeting. Over to you, Sumit.
So the meeting was specially held to, in a way, put more focus on the recovery of written-off loans. If you look at data over the last 5 years, 7 trillion rupees worth of loans have been written off. Recovery has been dismal at 1 trillion rupees, and 6 trillion has not been recovered. So this amount is staggering, and looking at that, Finance Ministry has told public sector banks to once again pull up socks and go after the accounts from which the amount has not been recovered. They want banks to take every measure possible to do this, to have this made possible, and for that the meeting has taken place. Overall, the ratio of recovery is 15%, but government wants this to be 40%. Finance Ministry has put a target of 2 lakh crore rupees of loans before banks to be recovered this year. It helps in many ways. First, it helps improve the financial position of economy and the country, and second, it showed up the overall balance sheet of the bank. So keeping both in mind, Finance Ministry has been tough on banks, especially PSBs, to bring back the amount that has been written off, and they want them to use any measure possible. Even they should go after the court cases that are pending in Supreme Court, High Court, NCLAT and other appellate tribunals. So keeping that in mind, the meeting was held and the objective was clear: for banks to come back with the loans that have been written off, and recovery should be faster.
Right, and shifting focus to the auto pack, it's an ET Now exclusive. Auto giant Maruti Suzuki eyes 15% sales growth in the current financial year. Sumit is still with us to bring us the exclusive details on this one.
So, from the last few days, Maruti was announcing a number of steps. In fact, it announced how it was done last year, performance there, profit and everything, 42% up. But now, it has given an ambitious target to its vendors. The target is of producing over 22.6 lakh units this year. For the first time, it will be crossing 2 million mark. And the vendors, around 100 of them, were addressed in Dubai Suppliers Meet, and they were told that they should be ready for producing as much as 4 million units by 2030. That's a mammoth and quite an ambitious target by country's largest car maker. Also this year, kind of sales growth they're looking at is 14 to 15% sales growth they are looking at. Maruti is looking at, and vendors have been told to be ready to ramp up production. They can face some problem this year, but they should be ready to ramp up production as they see demand coming back in very good numbers. So 4 million target for 2030 will include 3 million domestic sales, 1 million export target, and by that time Maruti also plans to have 50% of the market share once again. So it is quite an ambitious target set by country's largest car maker before its vendors. Its vendors include Lumex, Sona, also Minda and many other vendors. They have been with Maruti since last many years, but this is the ambitious target the vendors have been told about.
And centering our focus on earnings, Tata Steel beats estimates, clocks PAT at more than 1,700 crores against a loss of more than 2,200 crores in the previous quarter. Meanwhile, the company also recommends over 350% dividend share. Let's go across to an expert to weigh on the numbers.
Numbers have come out as a positive, means they have beaten estimates, that's right. So on all the fronts, revenue, EBITDA, especially on the EBITDA. So revenue was beaten by 4%, EBITDA stood ahead of consensus by 27%. And the beat on the EBITDA level is mainly driven by the Indian operations. European operations have also improved quarter over quarter, but the EBITDA per ton is still at negative level at European operations. So good set of numbers overall.
Right. Let's quickly take you through what brokerages are saying about Tata Steel as well. So we have Morgan Stanley, which is of the view that they've maintained an equal weight on Tata Steel, target price of 110. You can see that on your screens. They believe that it's a good beat by Tata Steel on the standalone business. Europe continues to struggle according to them. They believe standalone EBITDA was much stronger, and it's led by better realizations and lower OPEX, and that's the positive. Consol EBITDA was lower than the standalone, as the European business and Tata Steel Long subsidiary continued to post EBITDA losses, according to Morgan Stanley. Switching over to JP Morgan, they continue to maintain their overweight stance on Tata Steel, target price at 150 rupees a share, so super bullish there. And they believe that the strong India ops is offsetting the weak Europe, and that the India ops is largely driving the beat for Tata Steel. They believe that that given the sharp fall in coking coal prices, the margin trends remain broadly stable for Tata Steel. The debt reduction is a positive, and they are expecting a positive stock reaction given the Q4 numbers. Solid Q4 from Tata Steel.
All right, we'll shift gears to Titan. That is all set to report its Q4 numbers later in the day today. The street is expecting a jump in both revenue and net profit. My colleague Winnie, who tracks the sector very closely, is here with more details on what to expect. Take it away, Winnie.
So the jewelry maker Titan is expected to report its Q4 FY23 numbers. We're expecting a double-digit growth of 24% in terms of the total revenues of the company. Obviously, we do have a fair idea what to expect because of the operational update. Profits of the company expected to see a growth of 54%, while margins expected to see an expansion of around more than 100 basis points, at 12.1% versus 10.7% are the EBITDA margins last year. Now, revenue growth will be mainly aided by the higher growth and contribution that we're seeing coming in from the watches segment, as well as the other emerging businesses which have seen a strong growth as well. We are expecting to see an improvement in the studded ratio. It's expected to come in somewhere around 35%, which obviously will augur well for the margins of the company. When the studded ratio is higher, that works out well because they are high value products. So that is why margins also expected overall to start seeing an improvement, and will come down in terms of the margins and the profitability as well. Obviously, profitability is expected to be better in most of the segments as well across businesses. What the commentaries come in terms of operational update is that Jan and Feb saw a strong demand and contribution in terms of performance from consumers, but March, that was a bit of a subduedness that they saw because of the hike in gold prices. So in terms of commentary also, we'll watch out for what is the impact of the gold prices, anything in terms of consumer sentiment getting impacted. Competitive landscape is a factor we are keeping an eye out on, and in terms of any change in product mix, performances of watches and wearables as well as the eye care business is something that we're keeping an eye out on.
Right, tons to look out for as Titan declares its Q4. But quickly moving on, a slew of financials were in focus through the weekend, and that's largely on the back of earnings, of course. We had a chance to speak with the managements of IDFC First, Satin Credit Care, as well as M&M Financial and RBL Bank. Take a look at what they had to say.
Our bank is really very good in getting deposits. There are branches, there are network. Customer products are quite customer friendly. We focus really a lot on customer service. Like, we go crazy about it, and we put a lot of systems and controls and tracking and monitoring and feedback loops and correcting our systems. So we put a lot of effort in customer service. Brand has come really well. By the way, Nikunj, people think of a brand as a good, clean bank. So all of these things play a role in deposits. We feel these are sustainable factors with the service of brand. Next year, last year actually deposits have grown by something like about 44%, even if you took out the one-off income, one-off deposits of 2,000 crores we got during the end of the year. So this year again, 40 to 45% growth you should expect from us, and I think we'll do it. Our CAGR growth and deposits is something like, at least retail is upward of 70%, which I'm now talking of 40%. I'm talking of slowing down, but still it's good, like 40%. Yeah, even 25, 26, we feel the bank will be very strong in deposit, because frankly, deposits not that difficult as it's made out to be. Because one is, of course, we're an early stage bank. Secondly, if you need more deposits, you just need to put up some more branches, go to new territories that we are not present in today, or open more locations, and you're in. So you should expect it from us that we'll do stronger deposits every year.
I think clearly we have seen growth across the country without exception in every state and almost every product, which is why, cumulatively we said that the sentiments are very, very positive. We are not seeing any pressure in any segment, at least at this stage, and we continue to believe that they would not do well. I think I would like to remind that we are playing in the largely earn and pay segment, and that's a reason a couple of years back we had pressure when this segment was not doing well. Currently, we see almost all vehicles, tractors, everything is fully deployed, in fact, to their full capacity. And we don't see any pressure on that front. And we continue to believe we will do well. In as far as the personal segments are concerned, we have entered the affluent customer segment, and we are offering very competitive rates out there to be able to compete. And that's helped us even gain market share. So you should overall understand that the segment that we were largely present in is doing pretty well. The new segment that we have entered into, we are actually gaining market share. And then thirdly, we have added new product lines like SME, LAP, etc. The three things together is what really driving the growth, and we don't see any concern around that.
Debt capital front, we are still very highly, we are very lowly geared. In fact, so we have got a lot of room in terms of growth. We are just geared at about 3 times our capital. Having said that, if we look at our capital adequacy is close to about 27%. It is 26.6%. For us to grow 25%, which is we have given our guidance, we don't require any additional capital because of the high capital adequacy which we've got. But if we over surpass this growth guidance, and if we require capital, it's not difficult for us to raise capital. We've been raising capital across the years as such. So, having said that, the growth guidance which we've given at about 25% plus, I think we still don't require capital now at the current juncture.
Our intention is to grow the credit to the tune of around 15% and retail to the tune of around 20% on an annualized basis. So we have just exited the year, rather the annual growth for retail was 21% and annualized growth itself is 24%. Sequentially, we did around 8%. And overall credit growth has been 17%. What is interesting to see is that housing loan, LAP, both put together was able to give me an 806 crores of last month growth. That is one. The second, housing loan per se itself has grown by 900 crores in last quarter. So these things will continue. In addition to that, we will have a two-wheeler, used car four-wheeler, then we will be having gold loan, we will be having education loan, we will be having SME loan, we are coming with the BBG, that's a business loan. All these things are in the form of being underway now, and it may start delivering from Q2 onwards. With all these things, we are gaining around 20% growth is the minimum what we are looking at.
With that, it's time to slip into a short break. Don't go anywhere. We'll be back shortly.
Welcome back. You're watching Market Cafe on ET Now. We have Brent crude, which has fallen 5%. We did speak about that at the start of the show, and Brent is below 70, or rather around that $75 a barrel mark. It's at 75.3 odd. This is the lowest level that we've seen Brent at since 24th of March and the biggest intraday decline since early January 2023. Somit is here with more.
Well, the reason behind this drop in crude prices, the sharp drop in crude prices, firstly the worries about the US bond default, then there is Fed policy outcome today, and more rate hikes are likely to come in. According to what the investors are worrying about. Also, the manufacturing activities in China fell unexpectedly in April, while Iran's crude production has also increased and crossed, in fact, the 3 million barrels per day mark, according to their oil minister. And these are the reasons why we have seen such a kind of a sharp drop in crude oil prices. Now, what is the impact on the Indian economy of this? Firstly, India imports nearly 85% of its crude requirement, and every $10 per barrel drop in average crude prices sorry for that, narrows the current account deficit of India by around 0.4% of the GDP. Also, the inflation, retail inflation comes down by around 50 to 60 basis points, while the wholesale inflation drops by around 125 to 135 basis points. Now, the impact on sectors and companies, if you see for oil marketing companies, it's a kind of mix, because a drop in crude oil prices does boost their marketing margin, but because of this sharp drop, there's also inventory losses that the oil marketing companies have to bear. When it comes to oil explorers like ONGC, Oil India, it's a negative impact because lower crude oil prices means lower realizations, and every 5% drop in crude oil prices, or every $5 per barrel drop in crude oil prices, impacts ONGC's and Oil India's EPS by around 7 to 12%. When it comes to paint companies, they would remain in focus. Nearly 40% of their raw material prices are derived by crude. When it comes to aviation, similar 40% of their total raw material, total cost is related to fuel cost. For lubricant manufacturers, nearly 50% of their raw material cost is crude derivative prices. Similarly, for cement, tire, and a host of specialty chemical companies like Balaji Amines, Alkyl Amines, Camlin Fine, Clean Sciences, Rosari Biotech, Nosil, Aarti Industries, Vinati Organics, Meghmani Organics, and Deepak Nitrate. So do keep an eye out for all these stocks in trade.
All right, thank you for that, Somit. Now, moving on, it was a muted quarter four for Astec Life. The company reported its first ever quarterly loss in the last 15 quarters. Now, what's ailing Astec Life? Somit is joining us back with more details on that. Over to you, Somit.
Well, Astec Life reported a loss, which is the first ever in the last 15 quarters. The company's revenues were down nearly 53% on a YOY basis, while its EBITDA declined nearly 92%. So what impacted Astec Life in the fourth quarter? Firstly, it was a sharp decline in product prices. Now, two of its key products in the enterprise business had reported a sharp drop in their prices, which impacted the enterprise business revenue, which was down nearly 72% on a YOY basis. Along with this, the performance was also impacted due to high level of channel inventories in India, and as well as as its export market, which resulted into demand-supply imbalance and subsequent correction in prices in this key active ingredients. Along with this, if you see the company's high channel inventory also impacted the company in the fourth quarter. Now, there's one silver lining also in the Aztec Life Sciences earnings, and that is the CRAMS business, which has seen a revenue growth of nearly 12% on a YOY basis, and this has been aided by a ramp up in its herbicide plant, which aided the quarter in the fourth quarter. When it comes to the outlook, the H1 of FY24 still continues to look weak because of the prices of these two key raw ingredients continue to remain on the lower side. Also, high channel inventory and more supply coming in the market are expected to impact the first half of FY24 for Aztec Life Sciences. However, for the CRAMS business, the outlook is much positive, and analysts are expecting nearly 40% growth for FY24, especially for the CRAMS business.
Right. We'll start looking at what stocks to watch out for in trade today. Lisa is here with us. She's going to take us through all the stocks to watch out for. Lisa, talk to us about the stocks and news.
Right. Firstly, on the earnings, Ambuja Cement has reported their earnings with the revenue that has grown by 8% year-on-year basis, while the EBITDA and PAT that has remained flat. Margin has seen some pressure, where EBITDA margin stood at around 18.5% versus 20.2% last year. Moving on to M&M Finance, they have reported on their operational updates, where they said that the overall disbursement that grew at around 39% year-on-year, and the healthy disbursements that has led to the business assets growing at around 1.4% over last year. Collection efficiency that was at around 92% for April, and the stage 2 and 3 assets that has remained range bound, while they maintain a comfortable liquidity chest of about 3 months requirement. Moving on to Indostar Capital, the promoters will be conducting an OFS today and tomorrow, and that is for around 1.93 crore shares, which entails around 14.2% share capital, and the floor price that has been set at around 95, which is a 23% discount to the market price. Moving on to Bharti Airtel, Dialog, Axiata Group as well as Bharti Airtel, they have signed a binding term sheet, and they will be combining their operations in Sri Lanka, and the proposed transaction will envisage Airtel being granted a stake in Dialog, and they will be representing a fair value to Airtel Lanka. BL Kashyap, they have, which is a small cap company, they have secured new orders aggregating to around 238 crore. Sterling and Wilson, some negative news flowing in for Sterling and Wilson, as credit rating that has been downgraded to BBB plus from A plus, and they say that negative implications will be on the EBITDA losses widening in Q4 as well. Lastly, Bombay Burma, they have said that they'll be assessing the impact of Go Airlines, which has reported for resolution proceedings under the bankruptcy code. So, well, these are the stocks that will be on investors' radar for today.
All right, then those are the stocks that we need to keep an eye out on. But moving on, then, Vamakshi, you have all the brokerages that are coming in. You have been scanning through them. Tell us, what are the stocks that we need to keep an eye out on? What are the brokerages saying?
Well, absolutely. First of all, a very good morning to all of you all. Let's first start off with some of the cement counters. They will be in focus after the note that came in from JP Morgan. JP Morgan is highlighting that it was a weak and noisy quarter as far as cement companies are concerned. Weaker pricing as well as loss of volume has impacted the Q4 performance, but the only positive coming in this time around is the large capacity addition. So given all these factors, they've actually maintained a neutral rating on ACC as well as Ambuja Cements. For ACC, they've cut their target price to 1,765 per share, while for Ambuja, they've also cut down their target price to 385 per share. Lastly, we will be keeping an eye out on Mahindra & Mahindra Financial Services, that is M&M Financial Services. We have the company reporting its operational update for the month of April, and we have a few brokerage notes coming in on the same. Jefferies has maintained a hold call with a target price of 270 per share, while Morgan Stanley is maintaining an overweight call with a target price of 310 per share. Largely, brokerages are saying that the disbursements momentum seen this time around was quite healthy. The asset quality remains range bound. The collection efficiency also rose in the month of April, and the stock could as a result command structurally higher valuation multiples as it builds on execution track record. So given all these factors, we do have brokerages appearing to be quite positive on M&M Financials.
Right. Thanks so much for that, Vamakshi, as well as Lisa, for taking us through all of those stocks. We will keep all of those on our radar. But with that, we're completely out of time on this edition of the show. We're down 75 points is what the SGX Nifty is indicating. But with that, we'll hand it over to the market to take the action forward. From Ankita, myself, as well as everyone who puts the show together. Thanks so much for watching.